Welcome to Spidel's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering internet startup companies and the timing regarding when these businesses begin and when development costs can be expensed, as outlined in a recent tax court case. But first, if you're looking for a year-end tax update, Spidel's Federal Tax Update webinar will cover individual, business, and investment issues, and you can see a full list of topics and get registered at spidel.com under the Webinars tab. In Kellett v. Commissioner, the tax court recently ruled that a taxpayer could deduct some of his internet company's startup and ordinary and necessary business expenses in 2015, even though the business didn't generate revenues until 2019, which was more than 3 years after it went live on the internet. The decision provides unexpected answers to some important questions. When does an internet startup company actually begin, and what software development costs can be expensed and when? The court's decision is an important acknowledgement that many internet startup companies will not be able to monetize their business activities until after they've built a strong reputation among a large enough audience. But this doesn't mean that the business is not actually operating before bringing in those revenues. The case involved a taxpayer who set up a Schedule C side business of an information technology website that provided a software interface that gave access to demographic, social, and economic data from various sources. Through the website, users could analyze the data and create charts, tables, and other resources to use in their businesses. The taxpayer envisioned at least 4 ways he could eventually make money from his business, but he realized the only way to maximize his long-term profit was by cultivating confidence and dependence among users and advertisers before monetizing the business. The website didn't even have a mechanism to collect revenue when it first went live. The IRS disallowed the taxpayer's expenses for software engineering, marketing, internet, and cell phone costs deducted on his 2015 return, saying that his active trade or business had not actually begun in 2015 because it didn't have any revenue or any means to generate revenue during 2015. The tax court recognized that prior case law dealing with more brick-and-mortar type scenarios didn't fit the taxpayer's business model, which was based on the assumption that none of his revenue strategies would succeed until the business built up its rapport with users and advertisers. The court sided with the taxpayer and held that even though he made no attempt to earn revenue in 2015, his business began providing the services for which it was organized with an eye to long-term profit when he launched the website, which was at the end of September 2015. But the tax court rejected the taxpayer's argument that he could currently expense all his software development expenses on his 2015 tax return under IRC Section 174 and Revenue Procedure 2000-50. The software expenses didn't qualify as deductible Section 174 research expenses because the software engineers simply adapted open source software to meet the taxpayer's specifications. There was no real research undertaken or any real uncertainty that had to be eliminated in an experimental or laboratory sense. In Revenue Procedure 2000-50, the IRS announced that it would not disturb a taxpayer's immediate deduction of certain costs of developing computer software that the taxpayer has not treated as Section 174 research or experimental expenditures. But the court rejected this position and held that the IRS had no authority to grant such discretion because a deduction wasn't authorized under the Internal Revenue Code, which requires those expenses to be capitalized. We covered this topic in greater detail in a recent issue of Spidel's Federal Tax Letter. To see details on this monthly subscription, go to spidel.com and click Publications. That's all for this week. Join us next time for another episode of Spidel's Federal Tax Minute.